Hey guys, this is Tim, Total Insurance Marketing. Thanks for tuning in, and today's topic is on Index Universal Life Insurance, IULs. Want to take a quick second before we dive right into it. I want to preface this with this is not a product that is typically sold in a one-appointment close. If you've seen my videos on mortgage protection or final expense, those can typically be done in one-appointment meetings. First time you meet with the client, you can sign them up. This, not so much suitable or appropriate to do with it. You need to have a completed fact finder, and if you haven't seen my video on doing fact finders, please reference that first. This is going to be when you know that the client needs life insurance. After all, this is a life insurance product, and it should be pitched as a life insurance product, not an investment. It does have cash value components, and we're definitely going to get into that, but this does have a death benefit. There is a cost of insurance. It is life insurance. So I want you and your clients to be super fully aware of all of that. So knowing that and going through a fact finder with your clients before coming up with this as a suitable recommendation needs to be done as step one. So this, I guess what I'm going to go over today is kind of step two in the process. So again, if you don't know how to complete a fact finder, haven't ever done one, anything like that, go visit that video first. But once you've done that, you've realized that this is a suitable product for them, I'm going to get into the nitty gritty of Index Universal Life for you. So with that out of the way, let's dive into it. So the reason for most Index Universal Life Insurance, obviously twofold, the death benefit, super important, but you can use term to supplement the rest of the life insurance if you need to. So primarily this is going to be on maximizing cash value for the client and making sure that agents are fairly compensated. So that's what I'm going to go over with you today, and the reasons why Index Universal Life versus something else. So I'm going to hop right into that and show you kind of what the investment options look like in today's day and age, and really why life insurance is a fit sometimes for that, when and why I guess it's appropriate. So without further ado, I've got a whiteboard behind me. I hope you can see that. I'm going to try and zoom in a little bit. And then hop on over there. So when you're thinking about retirement options and creating cash value for the future, there's a couple of things to understand. First and foremost, the reason they're called retirement accounts is they all get one thing. And so, you know, maybe you could name a couple that you've heard of previously when you get, you know, a normal 9-to-5 job, or you're the corporate executive of Walmart. They're going to give you this thing called the 401k. And this comes in different varieties. You know, this is the company's type of a deal, but there's also different stuff, 403B, 457. It's just the tax line in the tax code. So that's all that's really referencing. I'm hoping you can see this. I'm going to try and move this a little bit closer, I think, because I'm worried that you can't see the whiteboard. Oh, yeah. Now you can see it. Okay, cool. So with the 401k, the 403B, 457, you've got some other stuff. You've got IRA. It's definitely in there. All that is an individual retirement account. I'm not a tax professional. I'm not going to get super into the tax side of the world here. But when you have a 401k and you leave a company, you can convert that to an individual retirement account is all that is. And a lot of times when you do that, you have a lot more freedom. When you're in things like 401ks and other stuff, they give you, you know, your 20 options. And I hate to be so, I guess, blunt about it, but basically there's a small risk tolerance, risk time horizon questionnaire that they give you that says, you know, you should be this conservative or this aggressive, and you fall somewhere along that scale and we'll invest your money appropriately. You just pick out the funds that you want to based on how aggressive or conservative that you need to be. So that's all that 401k is some of those options. When you have an IRA, an individual retirement account, much more likely to have tons of different options. You can be in stocks or bonds or mutual funds. You can move that into Scottrade or the E-Trade baby. Love that kids commercials. All kinds of fun stuff. So gives you more freedom and flexibility to do stuff on an individual basis. And then there's things like Roth IRAs, and life insurance. Now, the good thing about all of these, can you guess it? Tax deferral. So I'm going to write it here. If you have $100 and you just put it in Scottrade or the E-Trade baby and it grows to 110, you got to report that gain of 10 on your taxes next year. And they're going to tax you on that. And so now you've got 109 to invest instead of 110. So what this allows you to do is invest the whole 110. We're not going to tax you on it immediately. We're going to defer the taxes. That's tax deferral. Super easy to understand. Now, there's kind of two kinds of thinking on this. Now we've got the stuff that goes in pre-tax and your money that goes in post-tax. Which one's a better option? Well, let's think about it strategically. Of course, it's good to do any one of these versus just tossing it into Scottrade because you're getting a tax deferral. But I'm going to erase that for a second so I can use the rest of the board here in a minute. And I want you to think about it strategically. You know, if you were a betting man, do you want to build your money, not pay taxes now, but then have that $1 million account at age 65 at retirement age, and then pay all your taxes? So pay taxes in retirement on that $1 million that you've accumulated? Or do you want to accumulate $1 million post-tax and have a tax-free retirement? You may be thinking, Tim, this is a silly question. But there's some people that haven't quite fully thought this process through, so I'm going to help walk you through it. The reason, and I guess there's multiple reasons why you want a tax-free retirement. First and foremost, there's a pretty good general consensus that taxes need to go up. And so you can either pay them now when it's low tax rates, or potentially pay it higher when there's potentially higher taxes. And let me do a quick, I guess, screen share of why it may be appropriate to pay taxes now rather than later. Screen share. Okay, we should be on it. And this is a great example, and you're welcome to pull this up to your clients. I think it's usdebtclock.org. And it just shows them, you know, Mr. and Mrs. Client, we've got $21 trillion of U.S. national debt, and that number's going up, baby. That's not going down at all. So we're, you know, going to have to pay the interest on it at the very least. Best case scenario, we start doing a balanced budget and you know, start paying off this debt. There's two ways of doing that. We can either decrease spending, which I don't see our government doing, not at a significant amount, because we're not going to need less police, less fire, less roads. I don't know what location of the U.S. you're in, but the roads here aren't terrific. So we're not going to need less of that stuff in the future. We're probably going to need more. So spending less is pretty much out of the question. The other thing, I guess, way to fix this U.S. national debt is to increase taxes. And you go, oh my gosh, well, eventually we're going to have to pay off this debt, or at the very least pay the interest. And this 21 trillion number isn't even, in my mind, the biggest concern, because you guys know what debt is. You get a credit card, you spend money on, you know, restaurants or whatever it is, and now you owe the credit card company $500. That's debt. This number down here, I'm hoping you're able to see my screen and follow along. This is the unfunded liabilities. It's 113 trillion, much bigger than this 21 trillion number. And that includes stuff like Social Security. It's not debt, but all the 64-year-olds, they're going to turn 65 and ask for their Social Security. All the 61-year-olds are going to turn 62 and ask for, an early Social Security. And there's all these things that we have to pay for the people that are already in the system. It's a liability. We're going to have to pay it, but it's unfunded. There's no bank account that we can draw on from this. So the only way to, fix that is increase taxes. So again, we're back to, you can either pay taxes now or pay them later on this retirement game that we're looking at right over here. And that's really the option. So most folks understand that it's probably a good idea to just pay the taxes now, get it done and over with, and live in retirement tax-free. You can also bring up to your clients, if you want, the national tax rate by year. This is 1936 or so, all the way through 1990, 1988 or so. It's been higher than 50%. So we are at not an all-time low for taxes, but it's on the lower end of the spectrum. So when you understand stuff like that, pretty clearly we're going to have to raise taxes eventually. So back on to this, if you have the option to, do that, most people understand, let's do some post-tax dollars. Now, there's some caveats to this, because there is a Roth 401k, but very few people have access to that. Most companies just have a traditional 401k. What I always like to say, if we're strictly looking at this from an investment point, which we're not, because this is life insurance, it does have a death benefit, is that this 401k only has those limited options, but if they're giving you a match, you put 3% in, they put 3% in, that's free money. Nothing beats free money. And if we're looking at it as a purely investment standpoint, nothing beats free money. Put your money in there, get the free money from the company, especially if there's immediate vesting, which means the second you put money in and they put money in, all that money is yours if you were to quit or leave or retire or get fired or whatever. Sometimes there's delayed vesting, which then you can kind of think about, am I really going to be here 5 years from now to get the vesting if it's, 10% a year and then 50% on the fifth year or whatever weird structure that they set up for you. But for the majority of folks, go get your free money, put your 3% in, and then after that, you can contribute to some of this other stuff. Also in 401ks and even Roth 401ks, you've got limited options. They're going to say, pick your aggressive or conservative level and pick your funds out of these 20 funds, and these are the funds, and that's it. And sometimes they have high expenses, they have low performance compared to their peers. There's a whole host of issues. There's a lot of compliance and legalities in 401ks, and sometimes they're done properly and sometimes they're not well managed. So kind of be aware of that. And in IRAs, you have more freedom and control, but you're also to blame more if you mess up your own individual retirement account. You don't have an advisor on it. So here's the thing. So we've come to the conclusion we want to do this post-tax dollars. We're still getting the tax deferral, but now we're going to have a tax-free retirement. And oh, by the way, it's more than just a tax-free retirement, because you're taxed on if none of the laws change between now and the next 20 or 30 years, or whenever you or your clients are looking at retirement, Social Security, the more income you make, if you were in this bracket, they're going to start taxing Social Security up to 85% of it, which is a lot. Or in the post-tax dollars, you can just withdraw whatever you want, because you've already paid taxes on it, and your Social Security isn't going to be penalized or taxed extra because of that. Also, Medicare. I don't know if you know this, but Part B, if the more money you make, the more money you earn and claim income-wise, if you were on this side of the bracket, that may increase your Medicare costs. Health insurance for 65 plus. Another topic, another video. But if you're on this post-tax side of the world, you're not claiming extra income. Taxes already been paid on all this. You're not increasing your taxable liability for Medicare either. So lots of extra benefits. I foresee more of Social Security, Medicare, that sort of stuff coming in the future. So if I were a betting person, definitely use the post-tax stuff for most of the young folks these days. So know that your options are traditionally on the post-tax side of the world, Roth IRA or life insurance. And let me just go over, and a lot of this is going to be true for this stuff too. There's penalties and fees and limitations and all kinds of stuff. So with Roth IRAs, there's an age thing. So if you're super close to 65, you can put a little bit more money in. But for the most part, you can put in $5,500 on a yearly basis. Cool. What's that really mean? Well, let's break this down. With interest and with growth and with blah, blah, blah. Let's say we've got 20 years between now and retirement. I'm just going to bust out a quick calculator and show you that if we add 5,500 times the next 20 years, we've got what you expect. And how much can we really do with that money over the next 20 or so years? A whole heck of a lot. You can safely double it, maybe times 2.5 if you're on the more aggressive side and you can take a little bit more risk and you can get a little bit higher rate of return. You can definitely double it. So let me just double it for you. Just for quick math, this isn't accurate at all. But I want to show you 220,000 is not a whole heck of a lot of money. You can't retire on that. So say you're 40 and you're going to be 60 in 20 years and you're going to want to be thinking about retirement. That's not enough to retire on. And that's the maximum. That's saying you can put in 5,500 this year and every year for the next 20 years and never have a bad year. You couldn't do that. So realistically, let's just say you've done really well. And between this and your Roth 401k and your 10 other investments, and maybe you've got businesses to the side, you want to retire early at age 45 or 50. Well, you can kiss this goodbye. There is a 10% penalty for early withdrawal. Not so cool. So if you try and withdraw funds before the age of 59 and a half, they get you with a 10% penalty. Now, on a lot of this stuff, you're also going to be forced to do required minimum distributions. Not so with Roth, but with the other pre-tax side of the world. And what that means is if you're not taking out a certain percentage, roughly 3-4%, and of $1 million portfolio, that's $30,000-$40,000, you're going to be penalized at 50% of what you should have taken out. So if you should have been taking out $40,000 and you don't take out $1 because you've got millions in the bank and you don't need it, they're going to penalize you approximately $20,000. So you're forced between that age 59 and a half and 70 and a half kind of time frame. The government's telling you to retire on these things, and you have between here and here. And there's a 10% penalty if you need to retire early or want to, because you can. And there's a 50% penalty on the stuff that you should have taken out but don't at age 70 and a half. And don't ask me why they do this half thing. It's weird. But so for our purposes, you can see life insurance, there's no minimum. There is no maximum. There's a little bit of a caveat. Financial underwriting has to be kind of the death benefit maximum on that. But for the most part, you can put in pretty much anything you want to as far as the life insurance goes. You're not capped at this 5,500 number. You can put in, $1,000 a month, $12,000 a year. Or you can put in $5,000 a month, $60,000 a year. And you can really accumulate. So if you find a 50-year-old that has some money to put away, you can have really big life cases. You can have huge commission cases, and you can have great clients that accumulate tons of cash value over the next 10, 15 years real quickly. So that's kind of why life insurance is, because it gets rid of, and also there's no penalty for early withdrawal. However, there's usually some type of surrender charge that's approximately 8 years or so. So know that time horizon is still appropriate to take into consideration. And if you've done a complete fact finder with your clients, like we recommended at the very beginning of this video, you'll know when this is appropriate. And if you need help deciding or doing case design with this, give us a call. We're happy to help you. Our number is 800-827-5110. I'm going to get back into some of the index universal life reasons for using this as an investment vehicle. So now you understand the tax situation with all this. Let's get into just real briefly how the internal rate of return works, the IRR, and what some places have come up with as far as good IRR and why there may be some additional thinking to that sort of stuff. So I'm going to hop back in here and see if I can probably do a couple of comparisons for you just to give you a quick explanation. Now, to give you the long story, I've been comparing these index universal life policies for a while now. The company I use most frequently and recommend to my agents they use most frequently, not my favorite as far as underwriting is concerned, to be honest with you, and not my favorite as far as lickety split issue. Big fan of mortgage protection and final expense because you can be in and out and get paid in a day or two, and have the policy enforced in a day or two. Not so with these index universal life policies. They are fully underwritten for the most part. And I would recommend doing these as fully underwritten. If you do simplified issue, you're raising the internal cost of insurance, which lowers the cash value that your clients are going to see. So definitely recommend going the fully underwritten route, which means there's going to be a paramedical exam. They're going to check the MIB. They're going to look at the prescriptions. They're going to make sure that this person's healthy. So not only do you have to do the financial underwriting and make sure that this is a suitable investment, but you also have to do the health underwriting. So a little bit more time consuming, of course, fully underwritten policies, 2 weeks kind of minimum in my eyes. And, 3 months is not a good situation. Worst case, longer than that. Sometimes depends on if there's a health concern or two, or if we're waiting on a doctor record for this or that. Not fun stuff. So typically I try and avoid those fully underwritten cases, but for these IULs, you need to be using it because they're going to be higher premiums. You want the low cost of insurance that this is going to give because they're putting in enough premium dollars to really make it worth your while. So let me hop over and do a little screen share with you. Apologize on the delay. Just got to hop over. This is from IUL Digest, and I'm hoping you're able to see this. I know I'm zoomed in a little bit, but this is really, it's ranking by the internal rate of return, the IRR. And they do a couple of wonky things in my mind. I like that there is an IUL Digest. I like that there is a company that's going and comparing this sort of stuff. In my mind, they should have consulted an IMO or agents that are actually in the field practicing this sort of stuff to make it a really good comparison rather than just the internal rate of return. So I'm going to show you what they're saying here is that Emeritus is ranking the top one. We've got Minnesota, Symetra, Allianz, Columbus, Midland, North American is here. A Nexus and F&G are pretty good, pretty well-known annuity companies, and so they've bridged over into this marketplace and they do okay. AIG, we won't get into my stories with them, but they're also not my favorite company on the list. We've got Transamerica, well-known, well-respected. Mutual of Omaha, same thing, strong financial ratings, great conservative company. Wouldn't think they'd be very high on the IRR, and they're not. Some others, Principal, other stuff you might have heard of, Voya, which bought out ING a while back. They were kind of popular. We've got Pacific Life is pretty recent. So I've just got a comparison showing them here as well. Prudential and AXA's down here, Protective. So you can kind of see how they rank it. Now, they do it on a 12,000 AP, and they throw in some guesses there as to what they're doing. So they're doing a S&P 1 year point to point, which is fine. I like that. I'm happy with that. They're doing 12,000, which is not an average case. I think the average AP on this is maybe 3,000 or 4,000, because there's a lot of them that come in at 2,000 for the AP. And then there's some larger ones. There's some people that are putting in 4,000 and 5,000 a month that make up some larger ones, but I wouldn't necessarily use 12,000 as the AP here. Option B, MSO, market stabilized option, assume current and blah, 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 which not a big fan of assuming current cap and participation rates. Give us a call if you want us to go over some of the reasons why on that. But here's my biggest complaint about the IUL digest here. They're doing it on target, and the target based on an AP of 12,000 is 4,900. 4,900, 4,900. We've got an oddball out here that's a little bit higher with Symmetra. And some of these numbers concern me, but other than that, they're all around 4,900. Well, when you go out and you sell a life insurance policy and you do a final expense or a mortgage protection, you expect to be paid a percentage of the AP. And whatever it is, 70%, 90%, whatever your contract says with your marketing company that you've got as a prearranged deal, but that's what you expect. When you're working with these companies, IUL Digest just automatically assumes you're running this number off target. Target's what you're getting paid on, not AP. So when I'm looking out for my agent's best interest, because here's the deal. It's not that I want my agents to be money hungry or greedy or anything like that. It's simply the fact that we need to keep, especially the newer agents, the agents that are learning this stuff and the good agents, we need to keep them around in the business. And the ways to do that is to help them get leads, help them to get in front of more folks, and help them to do case design and to pay them fairly. In my mind, fair pay is based on AP. It's not based on target. So everyone has their own opinion, but mine is, I'm a very agent-friendly kind of a guy and do what's in my agent's best interest. And part of that is making sure target is the AP. So I ran my own comparison, and it was based on target being AP, meaning you get paid on the full thing. The other variables, the 1 year point to point, 100% participation rate, and that sort of stuff. So that's what I compared it on. I'm going to hop back and share screens here. I may have to do 2 or 3 share screens. So give me a second. Let me switch over to Excel. So I just short simplified this one for you. Let's just use, you can use a 20 or 30-year-old female, just regular health rating, nothing super duper, 200 on a monthly basis. And for the next 30, 40 years is going to be appropriate. I wrote that 100% commissionable because that's target, that's premium. Cash value definitely matters, but it doesn't suffer that much when you're using it, but your agent pay matters dramatically, and I'm not trying to pay my agents half of what they're expecting when they're doing a policy like this. So that's what I based everything on, and I ran it for a number of scenarios here. I'm just showing you one of them, and you're welcome to call the carriers and do it yourself. I just wanted to show you what mine are all showing. Is North American is kicking the butt off the competition. Pacific Life is probably the most recent to market. And then Emeritus came out with a good product. They were #1 on the IRR of the IUL Digest, so I used them, and they're coming in a very close second here. But if you look at it, what happens is, most of these people are going to look at retiring at age 50 or 60. So what matters is the cash value at age 50 and 60. So I ran it, and this is what it looks like at age 50, and this is what it looks like at age 60. You can see all of them in there. Green means that's the first place winner in that particular category over here. And yellow means that's the second place winner. And, if you're into the Glengarry Glen Ross, third place can basically take a walk. So what we're seeing here is that North American came out first place in the cash value at age 50 and age 60, and later on as well too. The assumed interest rate based on everything. If you've seen some of the IRR with North American, actually, I'm thinking this is going to be slightly higher. It's going to be closer to 8% than it is. And some of the other ones I would feel the opposite towards. So know that. And if you really do your research, you can kind of be betting on that. The initial death benefit. So your client buys the policy. They're looking at growing their cash value, but maybe they pass away next year. How much good did your policy do them? If you're doing North American or Emeritus, you've got a pretty good initial death benefit. It's good. If you're doing Pacific Life, it's not so good. You've got a really super duper low. And maybe that's because I had to make it 100% commissionable, because I wanted agents to get paid on what they did, to be able to run everything else the right way. But then you also want to look at death benefit at age 60. So between now and then, North American's all the same. It's going to level that death benefit, which is cool. Emeritus does the same thing. Pacific Life grows as the cash value grows in the policy. Obviously, you can't have an initial death benefit and a cash value that outpaces it. So around age 40, 50 in there, the death benefit's forced to grow and keep growing. So when we've got cash value in there, to not mech the policy, modified endowment contract. So another discussion, another video, but wanted you to be aware, this is what I'm showing. This is the comparisons I'm getting. I wanted to be able to show you kind of what that looks like on North American's illustration, so you can see the internal workings of that. And I ran it for, you know, Emeritus and Pacific Life, but a bunch of other carriers too. And that's what I'm getting. That's why I like North American. We do help agents contract for North American if you need to get that contract, if you need some advice, if you need some illustrations ran, if you're needing some case design or marketing help. Again, we're here to be of benefit to you. Our number is 800-827-5110. Website is totalinsurancmarketing.com. And my email, super easy, tim@totalinsurancmarketing.com. Give me a second here, and I'm going to try and pop up the North American deal, if I can find it. Well, apologize. Here we go. I think I'm sharing the right one. Just going to make sure I'm on the PDF. Sorry, first time, I guess not first time, but first day using this. I've created quite a few videos here today for your viewing pleasure, but it is still making me go through this a little bit. So you can see, you know, there's nothing super significant about this. I made sure target was the 2,400 or within a couple of bucks of that. You can see that's the amount going in. I'm looking at the cash value based on the current interest rate. So that's what I'm using here. And then the death benefit. So these are the two lines. Well, I guess surrender is a little bit different than account value, but down in the future years, it's all the same. And you can see that here, you know, once we get, and this is kind of what I'm saying, they've got a little bit of a surrender charge. All of the companies do. So you want to be a little bit aware of that. But after 15 years or so, it's pretty much the account value is the surrender charge value at that 16th mark for this North American policy. So as long as the client's keeping it 10, 15 years, you're going to be in good shape with this. There's also a rapid builder product that they have that might be appropriate if you're trying to short build this in a shorter period of time, for maybe 50-year-olds that are wanting to retire soon and putting lots of money away. And so there's a number of things that you want to work with a marketing company on for all of this detail, but I wanted to go over kind of the internal workings of how the policy actually looks. You can see the policy looks pretty cool. You know, we've got a significant amount of cash value going through here. I'm just scrolling pages. You can see the end of year and also the beginning of age. So when we get there, we're looking at age 60, you know, close to that 400,000 mark. The cool thing, I mean, when you're showing these policies and you're showing $200 a month to a client and they're relatively healthy, maybe not even preferred, but just relatively healthy, these things can really bulk up in their end of life years. So say you've got a 401k, say you've got other assets, you know, if you keep doing this $200 a month until you're 74, 75, you know, you've got over $1 million in there, and it's got over $1 million of death benefit. So, you know, if you're healthy, you can roll this into a single premium whole life. If you're a good agent and want to make a significant amount of money, that's about 150,000 or so in commission, just off the top of my head. If you were to roll this over to them and create, $1.8 to $2 million immediately if you were to convert that, cash or account value or surrender value into a single premium whole life. But different topic, different video, all kinds of cool stuff that you can do with this. But say they live until the ripe old age of 90 and they just keep the policy because they had other assets really working for them. This thing blows up to about $4 million. So really cool. You can see how this is great for, if you want to put in $5,000 a month, cool. If you want to put in $200 a month, cool. This thing will still sing. It'll still grow to that $1 million mark. It'll grow tax deferred. It's all post-tax dollars, so you're going to be able to, withdraw from it tax free. Lots of good reasons why. North American's one of my favorites. You can see, I hope you can see anyway. I'm going to try and pull up real quickly here. This is Emeritus. This is the one that they sent me based on all the same criteria. I'm hoping I'm showing you for your viewing pleasure that you're going to see the stuff I saw in there. And they, again, were, 200 on a monthly basis, 540,000 or so, which is what I was showing you on the last IUL comparison versus the 610 that North American did level. So there's that. And then here we go, cash outlay. So 2,400 now to age 60 or so. What's that really look like for them? The account value is a little bit lower. Cash surrender is a little bit lower. This amount, this percentage is a little bit lower. So, if you're doing true comparisons, do a true comparison. Do it on your client. Don't just take the IRR of IUL Digest. I want you to be familiar. I want you to do what's appropriate for your clients. I want you to get paid the right amount of commission. Hopefully this was informative. I know there's a couple other things that I kind of wanted to jump into. Part of why people do index universal life, let me just go over that real briefly and I'll end this video and let you enjoy your evening. Part of the reason why people do index universal life policies, same reason people do annuities. I'm going to hop back in here so you can see the whiteboard again. Appreciate you guys. Okay, so here's the whiteboard again. You guys all understand that the market inherently has some risk. And over a long period of time, yep, you can see all that. Kind of cool. So they're all going to have caps and participation rates and all sorts of weird stuff. But what I want you guys to understand is that these things, these index universal life policies and annuities really came into play. Sorry, just tilt you up so you can see my face a little bit. Because we had 64-year-olds that had $1 million here. You see that? Yep, I hope so. And then they'd retire and we'd have the stock market crash of 2008, 2009. And they would retire with, I know this isn't, super accurate. I'm just doing it for illustration and I think the whiteboard is kind of hurting me. And they've got, somewhat aggressive risk tolerance and they're losing 40% of their portfolio just overnight. And they go from, I've got $1 million at age 64, I'm about to retire. Oh crap, the market tanked through no fault of my own. Now I've got 600,000. And what was happening was we had people that were overly aggressive in the market that didn't understand, didn't use a financial advisor, that were not doing anything about this and taking on too much risk. So these annuities and index universal life policies are simply tools to take away some of the risk. So I'm going to show you real briefly, and it doesn't work exactly like this because there are caps on participation rates. What that means is North American, as an example, has a zero downside protection. So if the market goes down, your cash value doesn't go down $1, which is nice. And so if you were here and the market tanks, you're still here. And I'm going to illustrate that here in a second for you. but it's also got a 12.5%, 100% participation, but 12.5% cap, meaning if the market goes up 10%, you'll get 10%. If the market goes up 30%, you're going to get 12.5%. The insurance company has got the spread on that, and the max that clients can make is 12.5. Not a bad deal for keeping the downside protection, but know that there is a cost, or I guess an opportunity cost on the investment side. If they were fully invested, they could have gotten a higher rate of return. 12.5% though, most of my clients, especially with, you know, whatever their risk tolerance is, it's going to be okay if they're getting 12.5%. They're not going to come to me mad next year saying, Tim, I got 12.5%. I'm going to say, hey, we beat the 8% that we were looking for, or whatever we were looking for, and we're going to move on and have a good year next year. And if it was a crappy year, they're not going to lose $1. So either way, you're not getting clients mad at you. So just for illustration purposes, let's assume this is 12.5%. I know it's not grammatically on the whiteboard here, but let's assume that was 12.5%. You're here, the market tanks, that's okay. Your cash value rides it out to the following year. And then as the market goes up, you're getting the next up. And as the market crashes, your cash value is staying exactly the same. And then as the market goes up again, you go up again. And then as the market crashes and burns and everybody screams, oh, the sky is falling, your cash value is still right here, which is pretty cool. So that's the reason people use annuities and index universal life. Again, both in annuities, you're going to usually have a surrender period to get something cool like this, and you're still going to have those caps, so you're losing something there, so be aware of all that. And then in these life insurance policies, it's not really I guess there's a surrender period, but it's graded and then it goes down, and it's usually 8 to 15 years depending on the carrier. So there's some caveats with that. Definitely call a marketing company if you are needing more information or concerned about that or need help with case design. Again, you can go to our website, totalinsurancemaraketing.com, or you can give us a call, 800-827-5110. I appreciate you guys watching this video. Please share it with your agent friends if you think it was of value to you. And I look forward to seeing you next time. We are putting out lots of new content, so go ahead and check us out. We're going to be on Facebook and YouTube, as well as have this all on our website very shortly. So thanks again. Take care. Have a great night.